Hi everyone, my name is Jason Fleming and I'm one of the senior lending specialists here at Dealstruck. I'm going to welcome everybody to our introductory webinar on the Dealstruck asset-based line of credit. This is one of our most popular and effective products in addressing what is often the number one challenge for any small business owner, which is cash flow. Fixing the cash flow issues of a small business is one of the most powerful ways to position that business for continued yet manageable growth. We often at Dealstruck see companies hit a plateau when they lack adequate cash flow. They can quite literally grow themselves out of business as the company is starved of cash as it scales. Ongoing access to capital through a credit line is one of the most powerful ways to solve this cash flow problem. Let's take a look at some of the industries that are good candidates for the Dealstruck asset-based line of credit. Generally, most kinds of business-to-business companies are going to be a potential fit for the credit line. This includes manufacturers, wholesalers, staffing companies, consultants, and all kinds of business service providers. We can also help subcontractors and government contractors. Companies that have recurring revenue tied up in accounts receivable, any kind of business like that is generally going to be a good candidate for the Dealstruck asset-based line of credit. And the funding needs are often the same. These companies often have a challenge in financing recurring operating expenses such as payroll, supplies, materials, inventory, and taxes, like payroll tax and sales tax. The credit line is designed to address these revolving needs because it itself revolves, as opposed to one-time fixed expenditures, which would be better fit for the Dealstruck term loan. Of course, as many of you know, companies can simultaneously have a revolving need and a fixed need, and they can get a term loan from Dealstruck in combination with the line of credit. Let's get right into an example of how the asset-based line of credit actually works. Imagine Tim's manufacturing company needs financing to meet payroll and buy supplies, a very, very common challenge for any small business owner. He has $100,000 in outstanding accounts receivable. Dealstruck can advance Tim up to 85% of his eligible AR, anything less than 90 days past due. So this means that Tim has the flexibility to draw any amount of money from his credit line up to $85,000. That's one of the key features of the credit line, of any credit line, as it allows the borrower to be very pinpoint with how they finance their business. They only draw what they need when they need it, rather than just maxing out the line simply because it's available. Let's assume Tim draws $20,000 from his credit line to finance payroll and supplies for the next 30 days. On day one, he gets $20,000 of cash deposited into his operating bank account. That reduces his availability from $85,000 to $65,000. On the $20,000 draw, we would normally charge a servicing fee of 1% or $200. At an interest rate of 21.25% APR, which is equivalent to prime plus 17.99%, in 30 days, Tim would accumulate $357 worth of interest on that draw. If we add that $357 to the $200 servicing fee and the original draw amount of $20,000, at day 30, the balance on the credit line is $20,557. Now let's look at how the credit line gets paid down and revolves. Dealstruck establishes a lockbox account to receive payments in order to secure the receivables to the credit line, ensure the credit line gets paid down, and most importantly, that it revolves. On day 30, Tim's customer honors its invoice and sends $50,000 of payments into the lockbox account. Out of the $50,000, the balance of the credit line is reduced from $20,557 down to zero. Above and beyond the balance of the line of credit out of the $50,000 payment is $29,442. And that money is routed immediately from the lockbox account into Tim's checking account. So if you looked at Tim's checking account, you'd actually see a deposit of $29,442 the same day that the $50,000 flowed into the lockbox. We don't hold any money in that account, in that lockbox account, in reserve. Now let's talk about how Tim's credit line rolls forward into the future. Remember, $50,000 flowed in at day 30. paid down his AR from $100,000 to $50,000. And if we imagine that Tim billed another $75,000, his new total accounts receivable would be $125,000. We advance another 85% on that, and his updated available credit line is $106,250. As Tim's business grows, he's going to sell more. He's going to sell more. That's going to translate into more accounts receivable. It'll also translate into higher costs associated with supporting that higher level of sales. So it's incumbent upon Dealstruck to raise Tim's credit limit so he always has access to enough cash to support the higher level of sales. We often here at Dealstruck see companies that started a smaller credit line availability. They use that cash that's otherwise tied up in AR to capture a lot of new business. Their AR balances grow very quickly, so we need to raise their credit line limit in order to support that higher level of sales. We want to use this as a tool for the small business to capture new accounts, capture new business, land new contracts that they otherwise wouldn't be able to land simply because the cash was locked up in their AR. With the credit line, they don't have to worry about that anymore. The number one question our affiliates and customers have about the asset-based line is how the lockbox works. Simply put, the lockbox is the mechanism we put in place to ensure that we get paid back for the funds we advance against the borrower's AR. Many small businesses would never have to borrow for everyday operating needs if their customers paid them in a more timely fashion for goods and services already rendered. However, many companies have to offer at least net 30 credit terms in order to land new business, retain customers, and expand their relationships with customers. But it's important to know that the lockbox account is established in the name of the business at Wells Fargo, which is Dealstruck's bank. This lockbox can accept payments electronically or paper checks through the mail, as each customer's lockbox has an associated P.O. box that can receive mailed checks. All checks and electronic payments from the borrower's customer are still made out to the borrower and not Dealstruck. So the check that might be sent into the P.O. box is still written for the name of the company. The electronic deposits, the wires and ACHs that go into the lockbox account are still made out to the name of the borrower company, not Dealstruck. At the same time, the invoice that is originally sent out to the borrower's customers. Those are still generated in the name of the borrower. They say Dealstruck nowhere on them, as opposed to a factoring company, which would rubber stamp those invoices. Dealstruck invoices, or our customers' invoices, remain simply in the name of the borrower and not us. Finally, if the line of credit is paid down in full, any incoming AR is immediately routed to the borrower's operating account. There are no float days. This is a very common tactic in invoice factoring, where if the factor holds payment for additional days, they can essentially charge higher fees by moving that customer into a higher cost bucket, and aging their receivables unnecessarily. Speaking of factoring, here's a side-by-side breakdown of some of the key differences between our asset-based line and invoice factoring. On our credit line, collection activities remain the responsibility of the borrower. When a business factors its receivables, they assign collection rights to the factor. That means the factoring company is literally collecting directly from the borrower's customers, and that can be awkward and invasive. Some companies refuse to work with a factor for that very reason, limiting the amount of capital that borrower can access against their invoices. On our credit line, availability is determined by a summary AR aging report. In factoring, availability is determined by the gross value of individual invoices, and this leads to a lot of cumbersome recording, handling, validating, and ultimately collecting on individual invoices. On our line, interest accumulates only on the amount drawn. In factoring, fees are charged to the gross value of the invoices regardless of how high the advance rate is or how much the borrower actually needs. And this allows borrowers to be a lot more flexible and pinpoint with how it finances its operating needs when they have a credit line. They only take what they need when they need it. They only charge interest on the portion that they actually draw for the time that the line of credit balance is outstanding. With the Dealstruck ABL, there is no minimum draw required. If the borrower doesn't need any capital, they literally pay nothing. also aren't any additional fees or escalator rates for older AR. The difference between a credit line that is paid down in 29 days versus 31 days, for example, is 2 days of interest charged at the same rate. We also make it easy to leave or terminate the credit line. It simply needs to be paid down to zero. You tell us to close down the line of credit account, and there is zero termination fee. Compare that to factoring. Most factors are going to charge more money for AR aged 61 to 90 days versus 31 to 60 days, and also charge higher fees for AR aged 31 to 60 days versus 1 to 30 days. Most factors will also require a borrower to finance all of its AR or maintain a certain minimum volume in order to maintain access to capital, even if the company doesn't have a cash flow need at that juncture. Factors are also notorious for charging very, very high termination fees, often in the tens of thousands of dollars, to get out of a contract early. It's also common for factoring companies to roll over a contract. Unless the borrower notifies them that they intend to leave with at least 60 days advance notice, the borrower is often rolled into a new contract and they continue to be liable for that high termination fee. Finally, because Dealstruck underwrites the entire business and looks at the big picture, we can get comfortable with advancing on things that no factoring company would ever touch. Factoring companies will generally limit the underwriting to the validity of the invoices they receive and the creditworthiness of the borrower's customer. Because we look at the big picture, we have the ability for special advances on things like purchase orders and signed contracts. There isn't enough collateral from pure accounts receivable for a customer to capture new orders and contracts. Dealstruck will certainly consider a special advance on a purchase order or a signed contract. In factoring, they are going to strictly limit the advances to domestic commercial AR on credit risks that they feel comfortable with, and they can get very, very particular about what accounts they will ultimately advance on, which can reduce the access to capital that the borrower ultimately has. Of course, small businesses can and do use merchant cash advance style financing to bridge cash flow gaps. And we view this as a far, far less favorable way to finance businesses in a cash flow situation than even factoring, let alone our line of credit product. So let's assume instead of using our ABL, Tim decides to finance 30-day of payroll and supplies using a $20,000 merchant cash advance. If we assume a 3% origination fee and a 1.25 buy rate or factor rate on that loan, his total cost of funds is $6,200. Also, because a cash advance by its very nature doesn't revolve, and he uses all of this money in the first 30 days, he has access to zero lender funds at day 30. This fundamental mismatch between need and loan structure is why stacking one merchant cash advance or daily debit loan behind another is so common in our industry. Now let's compare that to using the credit line to address the same need. Tim's cost of funds on that $20,000 draw, if you'll remember, is $557. And because he's billing his AR, the credit line is revolving. Payments are being made on the credit line, but his credit line is also growing because he's adding AR. He has lender funds available at day 30 of $106,250. He never has to take out a cash advance in order to bridge cash flow gaps, and he'll never not have access to capital as long as he keeps billing. And by using the ABL instead of a merchant cash advance or a daily debit loan, Tim ultimately saves $5,500 or more in interest and fees to address the same need in maintaining access to capital 30 days later. By using an MCA, Tim spends literally 10 times more to fund the same need and has no more cash available without at least renewing or taking another MCA at a very high cost. Again, that's what leads to stacking in many cases, is they use up all the funds to address the cash flow gap. They need more capital at some point in the near future because they have more money locked up in AR, and they have no more money from the cash advance guy, so they either renew with them with a very high cost loan, or they get another MCA to add on to the existing MCA that they're still paying off. Very, very poor way to finance the cash flow gaps of any business. That's all I have for today. If you have any questions, please send me an email or give me a call. Happy to walk you guys through any questions I can answer for you on this product or any of our other products. Thanks for the time. Thanks for taking the time to listen, and I will catch you down the road.